Greetings, everyone. Today I'll be presenting on behalf of our group on our research on digital monetary systems in transition, a comparative study of stablecoins, the gold standard, cryptocurrencies, and CBDCs in a cross-country comparison. As digital transformation reshapes the global financial landscape, new forms of money are emerging. Our research examines how different monetary systems, from the historical gold standard to modern stablecoins and central bank digital currencies, compare in terms of stability, governance, and economic function. We'll explore three main areas today. First, a comparative analysis of stablecoins, the gold standard, and major cryptocurrencies. Second, the interaction between stablecoins and CBDCs. And third, country-specific outlooks, focusing on Korea and the United States. Let me begin by establishing our analytical framework. Although stablecoins, the gold standard, and cryptocurrencies have vastly different technical structures, we can compare them using 6 key criteria. First, the value peg, what each system's value is linked to. Second, stability and volatility characteristics. Third, management flexibility and discretion. Fourth, issuer and governance structures. Fifth, practical use cases. And 6, key strengths and limitations. The gold standard fixed money's value to physical gold. Stablecoins maintain value through reserve assets in a one-to-one structure. Meanwhile, cryptocurrencies like Bitcoin and Ethereum have no fixed external linkage. Their prices are driven purely by supply rules, demand, and market sentiment. These fundamental differences in how value is maintained lead directly to the empirical gaps we observe in volatility, maximum drawdown, and other market indicators. Both stablecoins and the gold standard share a fundamental principle, achieving price stability by pegging money's value to a reference asset rather than leaving it to discretionary policy or pure market forces. The gold standard, widely used from the 1870s to the mid-20th century, legally defined currency units according to fixed amounts of physical gold. Central banks held reserves and committed to redeeming notes at anchored rates, restricting money supply growth to the pace of gold mining. Stablecoins are privately issued digital tokens pegged to specific assets, typically fiat currencies like the US dollar or commodities like gold. Despite structural differences, both systems rely on convertibility promises, reserve backing, and users' confidence in the integrity of backing arrangements. However, these systems occupy different levels of the monetary hierarchy. The gold standard was a system-level monetary order where the unit of account itself was defined in gold terms, and government policy was constrained by the need to defend gold parity. Stablecoins, in contrast, are instrument-level constructs. They don't define the unit of account for the broader economy, but rather replicate cash-like stability within the cryptocurrency system and at the interface with the fiat system. The backing assets also differ significantly. Gold standard reserves were relatively homogeneous, gold and key foreign currencies. Stablecoins exhibit much greater heterogeneity. Recent research examining 95 operational stablecoins found that most are backed by fiat, crypto, or hybrid arrangements, each showing different resistance to inflation, volatility, and compliance properties. In terms of scale, gold-backed money once constituted essentially the entire monetary base of participating economies. Today, stablecoins are smaller but hold significant weight in digital finance. As of 2025, approximately 240 stablecoins were operational, with combined market capitalization around $275 billion US, about 7% of that total cryptocurrency market. Regarding stability, the gold standard showed relatively low long-term inflation, but at the cost of short-term output and employment fluctuations. Stablecoins may aim to maintain stable nominal value in volatile cryptocurrency markets, but recent evidence suggests their stability is neither guaranteed nor inherent. For example, Tether deviated from its dollar peg in 2022 after the FTX failure, and USDC traded at a discount during the 2023 Silicon Valley bank crisis. These incidents recall classical gold standard problems of convertibility under stress, but unfold more rapidly in 24/7 digital markets. Now let's examine market data comparing stablecoins with major cryptocurrencies. Using 30-day rolling volatility based on the past year's price data, we found striking differences. Bitcoin showed high price volatility fluctuating between 25 and 45%. Ethereum fluctuated between 60 and 100%. Meanwhile, USDT's volatility remained between 0.3 and 0.6%, virtually static. This difference stems from stablecoins' one-to-one peg structure against the US dollar, not market supply and demand. The correlation analysis reveals clear structural separation. Bitcoin and Ethereum showed very high correlation at 0.81, indicating they're affected by the same risk factors. However, USDT showed very low correlation, 0.32 with Bitcoin and 0.25 with Ethereum. Maximum drawdown analysis further confirms this. Ethereum's drawdown widened to negative 55 to 60%, Bitcoin to negative 30 to 35%, while USDT remained near 0% throughout the entire period. These results demonstrate that stablecoins possess structural stability where prices are maintained regardless of market shocks. Regarding liquidity, Bitcoin's average daily trading volume ranged from $20 to $50 billion, Ethereum from 10 to 20 billion, while USDT maintained 30 to 60 billion. Although USDT's volume is comparable to Bitcoin's, its purpose focuses on practical financial infrastructure, providing liquidity for settlement and exchange pairs. In market capitalization, Bitcoin stands at approximately $1.74 trillion, Ethereum at $354 billion, and USDT at $184.5 billion. The fact that USDT accounts for about 8% of the total market, despite minimal price volatility, exemplifies the importance of stablecoins in the digital asset ecosystem. These differences trace back to fundamental questions of value formation. Bitcoin has a fixed 21 million supply cap coded into its protocol, with block rewards halving periodically. Current circulating supply has converged to approximately 19.8 million coins. Ethereum, after switching to proof of stake following the merge in 2022, implements fee burning through EIP 1559. At certain points, net burning causes the total supply to decrease. Conversely, stablecoin prices are fixed by reserves, fiat currency and short-term government bonds held by issuers. For example, USDT discloses quarterly reserve composition through BDO Italia attestation, consisting of approximately 84 to 85% US Treasury bills and cash equivalents as of late 2024. USDC maintains 100% cash and short-term Treasury-based collateral verified through Deloitte's monthly attestation. This table summarizes our three-way comparison. The gold standard provided long-term stability but rigid crisis response. Stablecoins offer programmability and accessibility, but face issuer risk and regulatory uncertainty. Major cryptocurrencies provide decentralization and fixed supply rules, but suffer high volatility and significant downside risk. Each system represents different trade-offs along the axis of stability, decentralization, and policy sensitivity. Moving to our second major section, the interaction between stablecoins and CBDCs. Both are digital currencies, but their design objectives differ fundamentally. CBDCs are digital legal tender created, issued, and managed by central banks with public policy objectives, maintaining monetary policy effectiveness, ensuring financial stability, and modernizing payment infrastructure. Stablecoins are privately issued and backed by specific assets or algorithms to maintain value stability. What's interesting is that these systems are not primarily competitive, but strategically interconnected. Several countries are accelerating CBDC research, specifically in response to stablecoin growth, concerned that widespread stablecoin adoption could substitute bank deposits, shift funds to private platforms, weaken financial intermediation, and disrupt monetary policy transmission. The introduction of CBDCs likely leads to road redistribution rather than simple replacement of stablecoins. We can envision several scenarios. First, the coexistence scenario. CBDC handles domestic retail payments and public sector settlements, while stablecoins remain in high innovation areas like cross-border payments, DeFi, and tokenized assets within regulatory bounds. Second, the strengthened regulation scenario. Only a small number of institutional stablecoins issued by banks and payment institutions survive, effectively converging to tokenized deposits. CBDC functions mainly as retail payment infrastructure. Third, the delayed CBDC scenario. If CBDC introduction is postponed, regulated stablecoins rapidly increase their market share, later forming competitive and complementary relationships with CBDCs on more equal footing. CBDCs offer significant benefits. After initial system setup, they incur almost no additional issuance costs, enabling more efficient budget use. Real-time money flow data allows more accurate implementation and monitoring of economic and fiscal policies. Comprehensive transaction tracking facilitates accurate tax-based identification. However, centrally managed CBDCs also pose risks. The most concerning is personal privacy infringement. CBDCs can track individual transactions, and since anonymity isn't guaranteed, they could become means of state intervention in economic life. Additionally, CBDCs could significantly reduce the fund intermediary and credit distribution functions of existing banks. Rapid payment services like TossPay and KakaoPay might experience significant decline if central banks can perform most payment services independently through digital currency. Let's examine country-specific examples, starting with the United States. The US is the center of global stablecoin ecosystem, while shifting towards strongly regulated private stablecoins. After the Terra Luna and Silicon Valley Bank crises proved that stablecoins could directly impact traditional financial markets and amplify systemic risk, the US enacted the Genius Act in 2025. This act places payment stablecoin issuance under federal and state dual authorization, requires one-to-one reserves in low-risk liquid assets like cash, deposits, and US government bonds, and imposes consumer protection obligations including regular disclosures and accounting audits. Only banks and authorized non-bank institutions can issue stablecoins, forcing algorithmic stablecoins or coins with opaque reserves to the market periphery. In contrast, the Federal Reserve's CBDC policy is extremely cautious. The Fed's 2022 report presented potential advantages alongside risks of reduced financial intermediation, privacy infringements, and cyber risks, maintaining the position that it won't issue CBDC unless benefits exceed costs, and there's explicit congressional and administration support. The Anti-CBDC Surveillance State Acts, which passed the House in 2025, further narrows the scope for retail CBDC introduction. Rather than restructuring payments through public CBDC, the US is designing a digital dollar system around strongly regulated private stablecoins and tokenized bank deposits, a strong regulation plus role distribution scenario. The European Union established the world's first integrated crypto asset regulatory framework through the MiCA regulation in 2023. MiCA classifies stablecoins into asset reference tokens and e-money tokens, requiring issuers to be authorized by member state supervisors, set aside reserves in high-quality liquid assets and near one-to-one ratios, and meet redemption, capital, and liquidity requirements. These provisions have been applied in stages since June 2024, greatly reducing room for unauthorized algorithmic stablecoins or coins with unclear reserves within the EU. Regarding CBDC, the Eurosystem entered the preparation phase in November 2023, designing the digital euro as public payment infrastructure, complementing cash and private payment methods. If legislation completes in 2026, pilot projects start around 2027, with first issuance potentially in 2029. The EU is deploying the digital euro as public infrastructure, while stablecoins under MiCA serve as regulated private complements, a reallocation rather than replacement strategy. China takes the toughest regulatory line on crypto assets among major economies. In 2021, it completely banned virtual asset trading and mining through a joint announcement by 10 institutions, even making it illegal for overseas exchanges to serve Chinese residents. Chinese authorities view dollar-linked stablecoins as paths to bypass capital controls and erode yuan monetary sovereignty, recognizing them as objects to control and replace, not foster. The digital yuan (ECNY) is designed as a domestic substitute for stablecoins, supporting policy goals like financial stability, tax collection, and money laundering prevention through real-time transaction data collection. Meanwhile, Hong Kong is reviewing introduction of fully collateralized stablecoins linked to the Hong Kong dollar and offshore yuan under HKMA leadership. This illustrates a national strategy combining CBDC-centered alternative scenarios on the mainland with limited coexistence involving tightly regulated stablecoins in offshore environments. After the Terra Luna crisis, Korea recognized stablecoins as instruments affecting financial stability and monetary sovereignty, converging toward a coexistence plus strengthened regulation scenario. The Virtual Asset User Protection Act, effective July 2024, provides first-stage user protection at transaction and custody stages. The Financial Services Commission announced a second-stage regulatory framework, including stablecoin issuer identification and reserve asset requirements. The Bank of Korea positions CBDC as public infrastructure for small value and public payments, while stablecoins play complementary roles in global and innovative use cases. Korea is exploring designs where fully reserved KRW stablecoins issued by banks are incorporated into the formal system. However, concerns persist about dollar stablecoins potentially being used to evade foreign exchange controls and stimulate capital outflows. Governor Lee Chang-yong noted that allowing won-denominated stablecoins without proper safeguards could stimulate demand for dollar stablecoins and complicate foreign exchange stability management. Comparing Korea and the United States reveals different approaches based on national interests. The U.S. Genius Act allows private companies meeting qualifications to issue stablecoins. Over 99% of the stablecoin market is dominated by dollar-backed stablecoins from private companies. If these become widely used for payments, dollar hegemony strengthens across cross-border transfers and trade settlements. Conversely, Korea faces the challenge of protecting KRW monetary sovereignty from digital dollarization. Dollar stablecoins' overwhelming convenience and accessibility compared to traditional dollars could potentially replace the Korean won itself, undermining monetary policy and threatening economic sovereignty. Korea has responded by explicitly regulating stablecoins as payment means and testing wholesale CBDCs in the banking sector. However, defending the KRW against foreign stablecoins isn't enough. Korea must establish a clear regulatory framework for the entire digital monetary system and actively participate in the stablecoin market. In conclusion, our research demonstrates that digital monetary systems are not replacing traditional structures, but rather redistributing roles and creating new equilibriums. Stablecoins, the gold standard, and cryptocurrencies each represent different trade-offs between stability, decentralization, and flexibility. The interaction between stablecoins and CBDCs is shaping the future of money through strategic complementarity rather than direct competition. Country-specific approaches reveal how national interests drive policy choices. The US leveraging stablecoins for dollar hegemony, the EU balancing regulation with innovation, China prioritizing state control, and Korea protecting monetary sovereignty while seeking digital transformation. As digital transformation continues, the winners will be those who can effectively balance innovation with stability, private efficiency with public interest, and national sovereignty with global integration. Thank you for your attention.